Good afternoon, welcome to the Market Wrap number 115. The concept here is to share some knowledge on the UK property market, some global markets, and so help our clients and those interested make informed buying decisions. Please do like, subscribe if you can. Let's get those numbers up. So this week, what have we got? We've got the canary in the mine. What's that about? Birmingham to get Commonwealth Games boost. UK tenants robbed of an extra room by rising rents. And can WeWork guru Adam Newman solve the global housing crisis for the work from home generation? So, the canary in the mine. The era of ultra low interest rates and cheap financing has driven the global house price boom. According to the Financial Times, in a report just released, in the 2 years prior to fourth quarter 2021, real house prices in the OECD climbed at their fastest pace since records began 50 years ago. In New Zealand, driven by drastic pandemic policies, including the closure of borders and some amazing stimulus programs, house prices increased by 43%. Average house prices grew to 10 times their median income there, which is quite phenomenal. Financial Times goes on to say that the bubble means that New Zealand is like a canary in a coal mine for other global markets that are concerned that housing crash may be on the horizon, and using New Zealand as an example. Everyone is watching to see what happens here. Like many countries across the world, New Zealand's mortgage rate fell steadily after the global financial crisis, but that changed in October. The New Zealand Central Bank started to push up interest rates. It was 0.25% for 18 months. Now it's up to 2.5% in less than a year. The rate is likely to double again by the end of 2023. So that's going to be a major shock to the system. And according to NZ economists, that their concern is it risks pushing the country into recession, as New Zealanders will rein in on their spending as inflation and the cost of living continues to soar. This is something we're seeing all over the world. So it's a microcosm, it's a small economy, but it's potentially going to give us an indicator. And this is why other markets, including Australia, the UK and the US, are watching what could potentially be called the Kiwi in the mine. The FT says, however, that there are 5 factors that could shield property owners in other markets from a mortgage rate hike fueled crash. Okay, number 1, the falling share of variable rate mortgage loans over the past decade. In the US, the 30-year fixed rate residential mortgage has become the most popular model available, and improvements in the quality of mortgage loans is another factor, which will lead to less of a chance of a housing crash. In the UK, as we reported, I think last week or the week before, I think 82% of all borrowers are on fixed rates. So that means that if interest rates do go up, they'll be insulated from it. The Financial Times goes on to say more than 2/3 of people given the mortgages in the US and the UK over the last 2 years now have a higher credit score. On top of that, we've got historically low unemployment rates. So it is a real rising income situation, and people can get work easily. There's a shortage of houses for sale in most of the advanced economies because there's just not the supply there. And many households have also accumulated large cash savings during the pandemic. The median house price has fallen 9.2% since November last year in New Zealand, and a peak to trough crash of at least 20% is now being factored in, which would be the biggest fall since the 1970s. That's pretty amazing. Let's all watch this space. Okay, Birmingham expect to see a 15% increase in housing prices this year. Why is that? The UK has hosted Commonwealth Games for 4 times since 1970, and following each event, property values have increased on average by 14.9% in that location.
Now it's gone to England.
As the host city in 1970, Edinburgh had an average house price of £5,487 at the beginning of the Games, £5,000. And an annual rise was recorded of 23.9% over the following year. Edinburgh hosted the event again in 1986. When the Games began, the city's average house price was £41,000. In the following year, it had increased by 5.8% to £43,000, which doesn't seem quite to be the sort of amount of increase. During 2002, Manchester was the host of the Games. The city's average house price was £65,000 as the torch was lit on the opening ceremony. By the end of the year, it had risen to £81,000, which is a 24% increase. In 2014, again, Games were back in Scotland, in Glasgow. 1 year after the competition began, average house price had increased to £113,000, up from £107,000. Okay, I think what we'll see now is an average of 15% across all of them. So how does this impact Birmingham? In Birmingham, property values could therefore climb to £255,934 by the end of this year, based on Commonwealth house price growth of 14.9%. In a statement, James Forrester, a spokesperson for Barrows and Forrester, the well-known real estate agent, said Birmingham has already enjoyed an extensive and ongoing period of regeneration, and future plans to continue this regeneration will further cement us as the UK's second city. This heightened demand will inevitably help cultivate local property prices as more buyers enter the market. You need only to look at the huge boost of the Olympic regeneration project in London Borough of Newham to see that exciting times lie ahead, not only for Birmingham's housing market, but for the city as a whole. So, could be a buying opportunity in Birmingham. Okay, now rising rents mean that tenants get one less room for their money. This was reported this week by the Telegraph again. And basically they did an analysis, or I think one of the big real estate agents have done an analysis, and they say that tenants have been robbed of extra bedroom after their buying power has shrunk at a record rate due to soaring costs and chronic shortage of properties to let. In July 2020, a tenant with £929 to spend each month could afford to rent on an average 2-bed property. That budget now only stretches to a 1-bedroom property, according to the estate agency Hamptons. That's where the research has come from. Meanwhile, the cost of an average 2-bedroom property has risen to £1,068 per month, equivalent to the average rent on a 3-bed home just 16 months ago. So what does that mean to us as buy-to-let investors? It's good news, because it means that we can get more return for our money. Our yield is going up. Tenants with the same budget as they had in 2020 must now be prepared to sacrifice a bedroom to find a home, in the biggest erosion of renting power ever recorded by Hamptons. They go on to say average rents have risen by more than 16% in the past 2 years, equivalent to an additional £165 per month, and 8.3% alone in the last 12 months. It comes amid a chronic shortage of rental properties as landlords sell up and leave the sector to avoid costly eco rules, which is the EPC certification coming in 2028, and higher interest rates. Average house north of Manchester and North will not make the cut and will need £12,500 to £15,000 spending on it. The supply of rental properties has fallen 9% in July this year, compared to the same month last year, and 52% compared to 2 years ago. So half what there was. Anisha Beveridge, fantastic name, of Hampton said, tenants aren't seeing their budgets stretch as far as they used to, and they are likely to be squeezed further by a mix of investors leaving the market and landlords left behind looking to pass on their higher mortgage costs. Great buying opportunity, I see that as. Renters renewing or searching for a new tenancy in London were short of the biggest increases. The average rent in inner London has surged by more than 33% 2,672 in the past year, after international tenants and office workers came back to the capital. Scotland and the Midlands also recorded double-digit growth of 12.3 and 10% respectively. So that's quite phenomenal. Basically, if you can get a good mortgage and you can get into the market, it's a good buying opportunity. That's what we believe, and that's certainly what we're doing for our clients, and I'm doing myself. Now finally, can the man who founded WeWork solve the housing crisis? Adam Newman launched the hipster office space provider and is now offering apartments for the work from home generation. For all that it's become a grossly overused word, Adam Newman is truly a disruptor. Let's just imagine a scenario. Okay, you rent a modern, trendy flat at a reasonable rate and are rewarded by receiving some equity for doing that. Everything works. You never had a problem once with the Wi-Fi or the heating, leaks, those sort of things. But if you did, you can be sure it would be fixed double quick. Just report it on your app. Your neighbours are like you. They're on the younger side, professional, creative, internationally minded. You see a lot of them because your flats come with co-living areas, a community. That's what you're buying into, a community. And it doesn't stop there. What if you get married? Perhaps have a couple of kids? Easy. You upsize to a bigger property in the same network, or move abroad. No problem. You just trade your flat for an equivalent in Bali or New York. Welcome to Flow. This is, according to the Daily Telegraph, the latest vision of the colourful Israeli-American entrepreneur Adam Newman, the founder of WeWork. He revolutionised commercial property by allowing individuals and small companies to rent fashionable shared offices at affordable prices. His latest venture, Flow, aims to shake up the housing market in the same way. It sounds truly amazing. Details of the new venture apparently are quite sketchy, but what we do know is that this week Flow won the backing of one of Silicon Valley's most powerful venture capitalists with a reported check for $350 million US to bring the same elixir of community and brand to the rental accommodation market. How about that? So that's the market wrap for this week. All eyes on New Zealand. What will happen? Birmingham house prices potentially to rise by 15%. Flats are getting smaller in the UK. Well, they have actually physically been getting smaller for the last 10 years. They're 10% smaller than they were. But now they're getting smaller because we can't afford anything like we used to be able to afford. And WeWork as a potential solution to all our problems. Please do like, subscribe and share. Thank you very much for listening. I hope you enjoyed it. And any suggestions, comments, please put them down below. Keep it clean. And I'll try and fit it in next week. Thank you very much. Cheerio.